On May 17, 1792, a secret meeting under a buttonwood tree sealed a pact that would make a handful of men unimaginably rich and set the stage for the first great financial collapse in American history. In the spring of 1792, New York was a city of 33,000 people, still recovering from the Revolutionary War. The federal government had just assumed state debts, issuing $80 million in bonds. These bonds were the original crypto, volatile, misunderstood, and ripe for manipulation. On May 17th, 24 brokers signed the Buttonwood Agreement, promising to trade only with each other and charge a fixed commission. It sounded like a pledge of stability. In reality, it was a cartel designed to corner the market and control prices. The promise, a fair and orderly market. The hidden mechanism, a closed club that could inflate or crash prices at will. The early believers were not just the brokers but ordinary citizens, farmers, merchants, and war veterans who had been paid in government IOUs. Desperate for cash, they sold their bonds at deep discounts to speculators. One of the most notorious was William Duer, a former Assistant Secretary of the Treasury. Duer had inside knowledge of Alexander Hamilton's financial plans and used it to amass a fortune. He promised investors 4% monthly returns, an impossible 48% annually, by trading bank stocks. Hundreds entrusted him with their life savings, lured by his reputation and connections. Duer's scheme was a classic leverage bubble. He borrowed heavily from banks and private lenders, using the money to buy up government bonds and bank stocks, driving prices higher. But he wasn't just buying. He was also shorting other stocks, betting they would fall. To fund this, he created a shadow banking system, informal loans, promissory notes, and personal guarantees that were invisible to regulators. The mechanism relied on constant price increases. If the market turned, the whole pyramid would collapse. And in March 1792, it did. The trigger came when the Bank of New York, suspecting Duer was overextended, refused to renew his loans. Word spread, and a panic ensued. Duer's creditors demanded their money back, but he had no cash, only illiquid assets. On March 23, 1792, he was arrested and thrown into debtor's prison. The market froze. Stocks lost 25% of their value in weeks. Banks failed. A mob dragged Duer's partner from his home and threatened to hang him. Alexander Hamilton had to step in, buying bonds to stabilize the market, the first federal bailout in U.S. history. The Panic of 1792 exposed the fragility of the new financial system. Many ordinary investors lost everything, while insiders like Duer's creditors eventually recovered their money. The Buttonwood brokers, seeing the chaos, formalized their agreement into what would become the New York Stock Exchange in 1817. They learned that crises could be profitable if you controlled the rules. The lesson for everyone else? When a small group controls information and access, the promise of easy wealth is a trap. The mechanism of deception, leverage, insider dealing, and opaque markets remains unchanged today. The birth of Wall Street was not a triumph of capitalism, but a cautionary tale of greed and manipulation. The Buttonwood Agreement was a cartel, not a public service. William Duer's collapse was the first of many panics that would follow the same pattern. Easy money, hidden risk, and a bailout for the connected. The lesson that still matters: whenever you hear a promise of guaranteed high returns, ask who controls the game. The answer is usually the same as it was in 1792. What would you have done? Tell us in the comments. Subscribe to Ledger Noir and uncover the stories money try to hide.